You're watching at France 24. Welcome to the business interview. I'm Markus Karlsson. The build-up was long and dramatic, and there were plenty of doomsday scenarios. But when the news came, it was met largely with a shrug of the shoulders. I'm talking about the downgrading by Standard & Poor's of France's AAA credit rating. And to help us decipher what happened, I'm joined here in the studio by Patrick Legland. He's Head of Global Research at the French bank Société Générale. Well, welcome to the business interview.
Hi, nice meeting you.
Now, we didn't see much of a reaction in the markets after Standard & Poor's slashed the credit rating of France and of 8 other Eurozone countries. Were you surprised by that? That, as I said before, the reaction was largely a shrug of the shoulders?
Yeah, I would say we have 2 elements to take into account. The first one is that this downgrade was largely discounted for France and other European countries. Certainly the question mark was, for example, if we take the case of France, would it be 2 notches or 1 notch? And at the end of the day, it has been only 1 notch, then to a certain extent discounted plus relief. The second thing is that ECB put a lot of money on the market in December, almost 1,000 billion euro, which is obviously a huge amount. And the question mark we could have on the market was how the market would react, would leverage on this to support auctions. That was the question mark.
So basically, would the banks hold on to that money, or would they actually use it in the bigger economy?
That it might be the first part of the answer, but also the fact that would investors be willing to subscribe? Because one of the reasons why auction in the past had some difficulty to find buyers for their bond was obviously the question of liquidity, but also the fact that many investors were fearing about Europe, the European system, and maybe about banks as well. And with banks putting a lot of liquidity on the market, it means that tension, certainly a risk, I would not say they have disappeared, but they have certainly eased, and we start to see investors coming back to the market. Now,
you spoke there about debt auctions, and when France, when Spain, and when even Portugal have gone into the bond markets to raise debt after the Standard & Poor's downgrade, their borrowing costs actually dropped off. Is that largely because of the ECB offering this cheap money?
In fact, it's if we try to understand how an interest rate is determined on the market, we have 2 things. There is a risk level or the risk perception for a country, but this risk can be right if we have the right level of liquidity between supply and demand. And what we have seen in the last few months is virtually not enough demand, then just rates going massively up because there were no liquidity, no demand. Now that liquidity is back on the market, we think that interest rates are going certainly more at what could be a normal level, a fair level, and we see investors coming back. By the way, what we have seen today, it's for auction in Spain, in France, not only a lot of demand, but interest rates easing, which is a positive sign.
But it seems almost counterintuitive that after Standard & Poor's comes out and says, hey, there's a problem here, markets, they just don't seem to care, and even stock markets have been ticking up ever after.
I would not say that investors, the market, do not care. The point that certainly the market went really too far in terms of risk perception. And we start to see now almost on a worldwide basis, investors being willing to put back in their portfolio some European assets, just to put a little bit more risk, just because they start to realize that, okay, certainly Europe will be in the next few quarters into a mild recession. Governance has still obviously a lot of question marks, but we see that political leaders, ECB, start to take really the real measures to support liquidity, to avoid credit crunch, and to put in place the right level of governance.
Can we completely put away the downgrades then, or is there a risk that all of this could actually come back to haunt us, let's say, in a few months' time or even a year's time?
I would say the main question mark on one side, yes, we might have other downgrades. At the end of the day, rating agency maybe will decide to go further. The main question mark will be what ECB does. Point number 1, will they stick to their approach to bring liquidity to the market? And so far, this is what ECB publicly said in their statements. The second part, what is the impact of this liquidity? Will this liquidity go in the economy? And will go as well to support the market? And what we are seeing so far is, interest rates, interbank rates starting to ease, liquidity starting to circulate, and the risk aversion from investors about Europe certainly being reduced.
you sound pretty bullish then about 2012. If we, for instance, look at the stock market, so far stocks these year, they've come up a little bit. It seems a lot more stable than in the autumn of 2011. What do you say to that?
I would be tempted to replace bullish certainly by less pessimistic, which put in context. But we have the combination of many elements. We have liquidity, more than €1 billion in December, and another ECB said that they will put again money on the market in February. We have interest rates which have been cut from 1.25 to 1, and we expect as general interest rates to be cut again at 0.75 before the end of Q1. We have euro, which has been falling a little bit, which is good for European competitiveness. We have US, which seems to be bottoming out, plus the fact that investors seems to be willing to put more risk in their portfolio. Then if you combine, let's say, this fundamental element which are going to a right direction and investors which are willing to put more risk in their portfolio, this obviously is far better. But I would be careful maybe with being, if I may say, too bullish. It's certainly being far too pessimistic in the past as far as marketing is concerned, and maybe going more back to realities, if I can say.
If we can say then that the markets are healing, albeit slowly, what does that mean for the real economy and for the man in the street? When will the real economy start healing again? Because of course the Eurozone economy is projected that it's heading for a recession.
Yeah. You know, there is a discrepancy because on one side the European economy is slowing down. We do expect growth being slightly negative in 2012, which is not a positive environment. On the other side, market anticipate. Market, have been certainly falling far before the economy really start to slow down. And we estimate that market, most of the time, anticipating by 18 months to 2 years. Which means that our view, we have certainly another 1.5 years to 2 years where economy will be, if I may say, relatively dull with relatively low growth on one side. But if there is confirmation that ECB is putting the right level of liquidity, that there is the right level of governance in Europe and the right approach to reduce deficit, all this being put into account will continue to support confidence in the market. But it will be a fragile environment, and external shock are always obviously possible.
Now, you keep coming back to the European Central Bank, which is, I suppose, it's quite interesting because you're not talking about the Eurozone leaders and how they are helping sentiment. Do you think then that Eurozone leaders, they're completely absent from all of this, at this stage at least?
No, I think what is important that on one side, ECB is preventing a credit crunch on the market, on one side. But on the other side, at the end of the day, if interest rates went down in the last few days auction, it's also because the market start to realize that political leaders in Europe start to take the real action to put in place governance and to tackle their budget deficits. And most governments are in a very, very proactive approach. It's not easy because, the construction in Europe, which is virtually done just in a few years from a fiscal approach, from a monetary approach, and obviously it's not an easy road, if I may say.
Now, many investors in the past 6 months, they have said basically that Eurozone leaders, that they're out of sync with the markets. Are you saying then that they're kind of becoming a little bit more in tune with each other, Eurozone leaders as well as investors?
What is either, I would say, unfair or complicated is that markets react very, very, very quickly. And obviously, political leaders need some time to discuss, to put all these countries in agreement. And we have always had a kind of delay. Or political leaders may be lagging a little bit market reaction, but that's the way it is. And on the other side, I think that's good to have market putting, to a certain extent, a kind of pressure on political leaders to continue to put in place the right reforms. And this is exactly the message of the ECB as well. What ECB has been saying in their last press conference, they are supporting liquidity, but they want also the right reforms to be put in place in Europe.
What's the biggest risk for you looking ahead in 2012 and for the rest of the year?
To be frank, I would see certainly the risk on the economic side. Firstly, will Europe have only a moderate recession, which is exactly what we're seeing at Société Générale, but frankly, we do not have such a big visibility. And if we were speaking about a serious recession in Europe, it would be far, far more complicated to start to address or to reduce deficit. The second thing is Germany. We have seen Germany having GDP growth slowing significantly in the last quarter. We expect for 2012 growth for Germany below 1% at 0.7%. Then it grows, but it's far less than the 3% we had the previous year. We need Germany to hold on relatively well. Then obviously, if Germany were going into negative territory in terms of GDP, it would be a very, very bad signal. The third part is US. US will have certainly a mild recovery with plus 2% in 2012, but this is very, very important. And last but not least, emerging market. We have seen emerging market, China slowing down, but China should remain in 2012 above, let's say, the kind of psychological level of 7%, which is very, very important for China to maintain the right balance in its economy. Obviously, if one of these elements, is it Europe, is it Germany, is it US, is it emerging market, we're having a serious slowdown or recession, mostly it would be different.
In short, we're not risk-free just yet.
Unfortunately not.
All right, thanks very much indeed. Patrick Legland from Société Générale. And with that, we're going to wrap up the programme. Thanks for watching France 24.